Let's have more on the markets here. Some investment ideas for you, and welcome in David Strzeżewski, CEO of Sound Planning Group. Thank you for being with us. So how are you feeling about the market overall? I mean, we are having our first losing week for the Dow in 5, but a lot of people don't think any rally is real.
Well, good afternoon. Great to be with you as always, Nicole. The world right now, I think, is beginning to change. It seems like as even the seasons right now are beginning to change, that that some of our economic forecasting is really starting to catch up with some of the data. So obviously, Federal Chair Jerome Powell came out yesterday and shared that he's a long way off from what they're targeting, a long way off from what they're thinking that they need to inflict as far as pain on the market. And so, of course, the Fed, messes with demand. And when you mess with demand, well, guess what? Earnings are going to be coming down. And I can tell you earnings are going to be coming down in a lot of different ways just based on my own experience in life right now. I mean, I've got a vehicle that's going to take 6 months to get one part for the engine. And so we're just expected to just not have a vehicle for 6 months because that's the world of supply right now. And so I think if we just step back for a second and not just look at individual positions, but maybe take a macro view, I think it's important to recognize that we kind of have an inflation crisis of supply, but not necessarily in demand. Now, our demand is high because supply is so low. But think about the things that we could be doing right now with energy. We've got an energy supply challenge all over the world. We've got a housing issue right now where we don't have enough places for people to live. Therefore, supply and demand determines that the prices are going up. So consumers, which are 70% of our economy, are really, really taking the hit right now, specifically the middle class and those even on the lower side. If you're making several $100,000 a year, yeah, you're going to probably make a few adjustments right now, but you don't feel it quite the same way as people that, the vast majority of their income is eaten up with that, the energy side of expenses and the inflation side that goes into groceries and healthcare, et cetera. So there's a number of things that I think, need to be paying attention to right now as we're finishing the year. But I think that we're right on track from where we've been estimating it'll go. We've just been believing that, through the midterms, it would remain strong. We allocated capital. We've risen on the upside here, but our opinion is that this is a bull bounce that's taking place. And so we're cautiously optimistic, but we're also looking for our exit points here as we're looking to preserve and not just head full in to a time with so many unknown variables as the winter and everything just starts getting so much colder. We're even missing a bunch of diesel supply today. So I don't know. There are a few things ahead of us right now that we've not necessarily experienced in near term.
Yeah, it's interesting how you call it a bull bounce rather than a bear market rally. I mean, I know you're trying to be optimistic in there, but it's undeniable, as you said in your notes. I mean, everything's sort of slowing, and you have to have some growth, some catalyst, some turnaround to make it less painful and things get better rather than worse. I mean, this is another losing week in the losing year of 2022. So when does the slowing stop? When does the catalyst come in? Have we hit the lows?
I would love to say that we've hit the lows. And so, my vote is it goes up forever. But here's the reality. Until we see a pivot or a pause from Federal Reserve Chairman Jerome Powell, we're going to have challenges here going forward, specifically even in the credit market right now. So, consumers are having a very big challenge with housing, as you'll see. There's my third point. I think this bubble just started to pop. We're seeing the air come out of it as the numbers are coming in, that inventory's up. I mean, I'll just share with you, I'm down to 2 houses here that we're trying to sell and just got the last one closed yesterday. But I got one property that's been out for, I don't know, almost 2 months now, and it's had very little action. And it's priced right, at least comparatively speaking, to where we've been in the past. So when are we going to see a pivot?
Rates at 7%. That's the problem, right?
Well, precisely, Nicole. So we went from 3% interest rates back in February and March, and just 8 months later, we're above 7. So that's a 40% increase in cost if you're going to purchase at the same price on the high end. So you could make an argument that we should see a 40% correction right now in real estate, but real estate moves slow and people are going to be less apt to move. If they've got a 3% interest rate mortgage, they got to buy something above 7 if they're going to leave. So I feel like a lot of consumers are maybe recognizing today that they're potentially a little bit stuck, and maybe the plans of moving aren't there. And so my biggest concern is what Robert Schiller's data talks about when he shares that, you know, the value of our homes going up or down have the most significant influence on how much we spend as consumers. So if our stock portfolio goes up, we spend, but not nearly as much proportionately than our housing. And so I think that we need to be paying attention to that housing number here, because it is absolutely a lagging indicator of our economy, and it has shown up right now.
Right, and it's the first thing to really show the turn, and as Powell acknowledged, it takes time. There's the lag effect, right? They're raising rates, but it takes time to get through the system. Housing really was the first to show that. How quickly, here's my thing I was thinking about while you were talking. You have to be in the market, right? Because how quickly can the whole narrative change, and then all of a sudden it's off to the races? Because that could happen on any given month, right?
Well, I think we're seeing it, honestly. I mean, like even October's bounce that we just saw, you know, which is wonderful. I believe a lot of that was an expectation of what's taking place here in midterms, because traditionally when you see a balance of power shift, the market wants to know a direction. And in this case, it would be neutral. If we, House and Senate go to the Republicans, president still has the veto power, essentially neutralizes things. So I think the market was looking to rally on that. So how fast could it turn around and rally? I don't know. The market wants to rally on everything right now. I think that the moves of Powell could, they certainly know how to turn this around quickly. I think one of the bigger things is, what are you going to do with mortgage rates when inflation still is probably going to be high for a longer amount of time? So maybe the answer is a 40-year mortgage and 40-year treasuries. Maybe we have, I don't know, there's going to be some changes to how commercial works. Let's just be honest here. How many people are wanting to go to their big downtown office right now and climb into an elevator at the same time that, we may have, challenges or the potential to work at home. So I think that there's big challenges going to be in metabolizing the debt of these large commercial properties that have shorter windows of time on the mortgages, and people that are kind of coming up on their lease terms and maybe right sizing. And so I feel like there's just so much that's contracting right now that, yes, the market can move around and we will have moments and highlights and places within it. It just seems like our supply chain and some of the way that things have been, this very fragile ecosystem has been disrupted, and it doesn't go back together very easily.
I like how you're inventing some new things I hadn't heard of, the 40-year. That being said, let's talk about, as we look at you talked about a strong dollar. Are there certain areas that seem more attractive than others at this point to you?
Well, obviously energy is looking pretty good right now. You're getting paid to wait out and to see, different ups and downs. Here's one thought. If there was a challenge with even one refinery, what would that do to our oil production, supplies, et cetera? Value would go up. So I don't see, a big downside for oil right now. In fact, I think that, it would be really bullish for the U.S. to turn on our pumps again, as we do it cleaner and safer than anyone in the world. I didn't say cheaper, but I said cleaner and safer. Regarding different places to be allocating our money, I am very, very, very cautious right now and want to share this loudly to those who are bond investors or those who are trying to say, hey, I'm trying to avoid risk right now because I'm concerned the market's going to drop. So traditionally, the answer is load up in bonds, except for if the answer is Jerome Powell's about to be raising rates more, you've got the seesaw effect. So when interest rates go up, the value of your bonds go down. That's why we've been seeing depreciations all year. We're going to see a lot more of that coming forward. Hopefully we don't see corporations go from, quality to junk status. That would also be a big deal. Or if we see cities and municipalities have challenges because taxpayers have moved from, the high income tax states through the great migration that happened since 2020. I mean, these are some of the things that keep me up at night that I'm thinking about. But I'm just going to share an idea here as a bond alternative that is not commonly understood, but I'm saying pay attention to it. Growth-oriented fixed indexed annuities, in my opinion, have never been stronger, and there's never been a better time to be able to say, hey, I can have 0% on the downside guaranteed, but I can participate in some of the upside if things do move forward. So again, I vote, it goes up forever. But here's the reality. That vote doesn't really matter because these economic factors are going to be what are changing. And so we just need to appreciate where we are in the cycle. And I'm going to say it's probably more important as an asset manager who's working with people that are over the age of 50 and in retirement. We don't have time, to come back from a big loss. And so how do we, remain invested that we can get some return? Well, these growth-oriented fixed index annuities should be able to do some of that in combination with some very good allocations of some idiosyncratic choices, energy. Yeah, I do think that there's going to be some bounce in tech. They've got tons of cash. There's some changing that are taking place. Obviously, Twitter's, new on the scene, and they've broken up the trifecta there, the monopoly that was happening. And, that's a whole nother factor to see as this midterm election happens, et cetera. So it's an interesting day in time. Thank you, Nicole.
David Strzeżewski, thank you so much. Good to see you, Sound Planning Group. Nice to see you, David. Thank you.
Pleasure's mine.
Coming up next.